Good morning, everybody. I'm Kurt Brown, and we've got several members of the investment committee sitting in here in the boardroom today. And I know I see inside the participants here, we've got people joining from all over the country. Hope you're great, enjoying the fall. I know for those of us out here in the mountains, it's suddenly turned cold. I'm looking out the window. There's a lot of stuff up on top of the mountains. It's white, and yeah, hope everything is going good. Financial markets have been unbelievable, and so we'll kind of dive in and get into some of this stuff. There is a Q&A. If you look on the Zoom there, I think most of us have gotten pretty used to using this technology, this slick technology. So if you've got any questions as we go, be sure to pop them in there. And we just, again, thank you for taking the time out. We'll try and keep this call relatively brief and hit on what some of the most important topics are as it relates to capital markets and the economy and some other things. We like to do this because, you know, it's really hard to get non-biased financial journalism, right? I mean, it's when you turn on the news and you want to hear what's going on in the economy and the stock market, it's almost become impossible not to have that commingled with political sort of lenses. And so we just want to give you the data, give you the facts, what's actually going on under the hood. What are we seeing that's good? What are we seeing that's bad? We've got a lot of clients, a lot of you that are on the phone today that are business owners all over the United States. We hear from you regularly. We also talk to fund managers of all types, whether it's, you know, bond fund managers all the way over to private equity managers, and what people are seeing, what's happening out there. And so we try to consolidate the best information that we get and then and be able to share it with you in, you know, a few minutes a quarter. So these slides will be available to anybody that would like them. The replay of this call will be available also to be sent out tomorrow. So let's dive in. So let's talk about, first of all, the things that we're seeing that are really good under the hood of the economy right now. As it relates to the stock market especially, and the broader economy, it sort of begins and ends with a handful of things, whether it's interest rates, liquidity in the system, but earnings is up there, probably in the top three of everything that we're seeing. What's interesting, we were looking at the other night, since the financial crisis, earnings of the biggest 500 companies in this country are up eightfold, 800% increase in earnings in those years since the financial crisis. You know, I know the market has gone up a lot, but even just in the past 3 years, earnings of the biggest companies in the world are up 44%. That's a big deal. You think about that, 44% growth of the biggest 500 companies in the United States. That is not a small feat. That is a lot of real, genuine growth. Here's just 2 years, right? You can see what GDP has done in 2 years, but look at earnings. And again, you're not cherry picking where you're starting from here. We're not starting from the bottom of COVID, which of course that's a huge, you know, 18-month window. But pre-COVID, earnings are up 36%, sales up 16%. This is massive. I mean, you're moving the needle on some really, really huge companies. Why does the market keep powering higher, right? If you look at what estimates are for earnings versus what the stock prices themselves are doing, look at this. They're moving in lockstep since the bottom of COVID. You know, we're coming out of that period, which is just one of the strangest periods of our life, and yet earnings just continue to advance at a really, really robust pace. So we can say what we will about how much the market's gone up. We'll talk about it being expensive. It is pricey, but the movement for the past year and a half has really been in tandem with what earnings themselves are doing, and it's a big deal. Okay, another thing that you hear a lot in the media is how much debt there is in the system. But we're going to show you that if you strip out government debt and we just focus on corporations themselves and we focus on households, there's actually not a lot of debt. In fact, most companies and households don't want more debt. So when you look at the amount of debt, corporate debt, that's being used by our corporations in this country, and you compare it to the value of its equity, we're actually making new lows, not new highs, right? So you're actually not seeing on a relative basis the addition of a lot of debt, with the exception of a lot of these zombie companies that we've talked about from quarter to quarter in the junkiest parts of our financial markets. And though there are exceptions there where a lot of sort of reckless debt is being used. But broadly speaking, we're just not seeing it. It's kind of the opposite of the narrative of what's being told to you in the media. Okay, here's another really kind of interesting theme that's playing out. With an economy that's so strong, we have really a record amount of open jobs, companies trying to hire. What's really bizarre about it, when we talked about this for 6 quarters in a row, is there's a lot of people still collecting some form of unemployment, right? The figures, you're going to see different figures because the government likes to drop off the people that have, quote, dropped out of the workforce. And a lot of that is gamesmanship with the numbers. So the real number is somewhere between 6 and 8 million people are still sitting at home on their couch that could work. And you've got 10.5 million jobs. So you actually are upside down, right? There's in theory a job for everybody that would like a job. But the problem is, if you live in Los Angeles County and you get maximum unemployment benefits, you're getting $24 an hour to sit home on your couch, right? How are businesses, how much do you have to pay somebody to have them? You have to pay them $30 an hour, $35 an hour to get them off their couch if they're making $24 an hour sitting there. This has become a real problem for especially small businesses and the labor type jobs in this country. So when we, later in the call, when we talk about supply chain problems, people going to work at the Port of Long Beach, people driving a truck for a living, this has become a problem, right? And what's happening is you're getting this wage inflation. This is probably not going to slow down in the next couple of quarters because the economy is hot. Companies are making money. They're going to have to pay more to get people off their couch. This is the ultimate solve to the minimum wage problem, right? You don't need, if you're a company, you don't have to tell me what the minimum wage is. I have to get people to come work for me. So this is righting the ship when we talk about the lowest income tranches in this country, and they are the ones that are gaining the fastest on the income plane. We could get into a wild political discussion about that, but we won't. But this is the dynamic of what's happening in employment. This I saw a couple of weeks ago. This is stunning, okay? This is pre-COVID, right? February 1st of 2020. There are almost 43% more jobs posted for since pre-COVID. Okay, 80% more off the bottom since the bottom of COVID. That is incredible. So when people talk to you about this market blowing a bubble, okay, the market might be expensive. Real estate might be expensive. And we can debate that, by the way, because we can make a case that it's actually not that expensive. Nevertheless, this is real, genuine growth that's taking place, and it's coming from almost every corner of the economy. We've talked about this for 6 quarters in a row. We'll talk about it again. We're actually not seeing a lot of reduction in the amount of cash that's on the sidelines. A little bit, not a lot. We've talked about this the last 2 quarters. Bank accounts are still bloated in this country. The commercial banking system has a third more cash in it than it had even 24 months ago. That's unbelievable, almost unprecedented. Very bullish, obviously. Most clients that we talk to that are sitting on a lot of cash are asking us, what do I do with the cash? Interest rates are low, but at the same time, stocks and real estate seems expensive to me. So where do I go with my cash? This is probably the most common conversation I'm having right now. It's not just households keeping cash, it's S&P 500 companies, right? They're not even off the accelerator on this, right? Still keeping a war chest of cash for things that they need. And what you're not seeing yet is you're really not seeing a move yet in stock buybacks, CapEx, dividends as a whole, compared to the size of the overall market. This can move higher and probably is going to move higher as corporations try to figure out what to do with this cash they're sitting on. Again, it's bullish. And I'm not saying stocks are going higher. I don't know. But the input and the engine under the hood is actually really, really solid. This is another thing that the media loves to hand-wring about. They want to talk about this debt that's in the system as if the average person in America is taking out a lot of debt. It's just not true. Debt since the beginning of 2008 at the household level has not moved. It's the same. It went down for a few years, and now it's back to where it was in 2007. But we have literally the assets that the average household owns in this country from the bottom of the financial crisis is doubled. Okay, so the average American household has twice the assets and the same amount of debt. That's incredible. So when you're hearing sort of this fear mongering about how, there's a sort of a recklessness to what's going on, we're not seeing it. We're almost not seeing it anywhere other than in those zombie companies that we talked about. And we'll touch that on again in a minute. Let's look at credit utilization, okay? If you take all the credit cards that are sitting out there in the US system right now, we've never seen Americans use so little of their credit. Now, a big part of this was because of stimulus, right? We went through a period where the government's just been giving away money so people didn't need to use it. But this doesn't fit the narrative. The narrative amongst the media is that, oh, everyone's using so much debt. There's so much debt in the system. The average household is not reaching for that. I've shown this before. I apologize if you're bored with this. This is one of the most stunning charts I've seen in my whole career. We are Americans, and as Americans, there's a rule we live by. When we make more money, we spend more money, right? As we make more, we spend more. And every economics textbook in this country speaks to this, right? Not the same in countries like Japan, but in the United States, that's how we operate. That is not what we are seeing right now. Americans are still mentally in a posture of being conservative, not knowing what to do with their money, not wanting to take out more debt, not wanting to get out over their ski tips, spending less than your disposable income. I know it's a shocking thing. We don't like to do that as Americans. That's the trend. That's sort of what's happening. You see it at the banks. This is the same data in a completely different way. For decades, if a bank gets more deposits, they loan the money out. This is how a bank makes money, right? Look at the decoupling and then look at the stalling, right? It comes from two things. One, there's a lack of demand, right? You are not seeing as many Americans that want to add more debt to what they're doing. And the second thing is the banks don't want to lend to subprime, right? They were burned so badly during the financial crisis that they are not wading back into that pool yet. And so what's happening is you're getting bloated amounts of cash sitting in banks, and banks frustrated because they don't really know how to turn that money into profits. There's really bizarre things that happen on a nightly basis. I saw the other night, 1.7 trillion went back into reverse repo window for one night from banks to make almost no money from the Federal Reserve. So again, tons and tons of cash out there in the system. We'll touch on housing just real quick. I've shown this every quarter for a few quarters. It's really important. When you guys have people coming to you and saying, oh, real estate is in this bubble again, we are in a dramatically different environment than we were going into the financial crisis. During the financial crisis and leading up to it, you had a lot of banks lending, giving mortgages to subprime borrowers, people with bad FICO scores, right? Look at this. We have a mortgage market almost entirely built on the highest credit scores in this country. And this is barely budging. We're seeing almost no mortgage origination to the really, really weak credit scores. So you just don't have a market being built on garbage. It's same on the debt side. Look, there's basically the exact same amount of mortgage debt in the system, but look at how much more equity is in people's houses. So that people's houses are much, much more of an asset to them now than really has been in a very long time. Look at the spread. Look at the amount of equity compared to really any other point. It's really become an asset for people. Here's another way of looking at it. Your mortgage debt service payments, right? How much your house payment is, as a percentage of your disposable income. Since the data's been recorded, it's never been lower. So even with housing going up, as if you compare it with low interest rates and people making more money, the average person is not spending as much money on their mortgage, right? So it feels like housing is in this runaway bubble. We're all scared of what happened in 07 and 08 again, but that is absolutely the opposite of the environment that we're in right now. Might have touched on this last quarter, but the survey data is really bad. So we probably see a stalling in house prices because it's getting to a point where people are like, hey man, I'm staying in the house I'm in, I'm fixing it up. I can't afford anything, I can't buy it. Okay, let's flip the side. What are we worried about? Okay, number one, nothing is cheap. It is really, really hard to find truly cheap assets in the system. There's so much cash and interest rates are so low and the economy has started humming so well that it's actually really hard to find something that's cheap. So we talk to fund managers, we talk to money managers, everything is basically on a relative basis what's cheap, or compared to interest rates, something is cheap, right? There's no way to get around this. Now, this actually continues to move a little lower. This was back in June. As the quarter has moved on, the market is going up and stocks are actually getting cheaper because earnings are growing so fast. So the red dot here is about where we are right now at this point in the quarter. It's kind of an estimate, but the market's actually gotten a little bit cheaper in the last 8 weeks. We need that to keep happening because stocks are just surging. So if earnings don't keep up, we're probably going to have some kind of market correction, like a real correction. I hear a lot about tech. People really hand-wring about tech. They like to talk about 2000. Again, like housing, it's asinine to compare what's happening right now to the dot-com bubble. They are nothing alike. Tech that's driving the world today are the biggest, baddest companies in the world. On top of that, the valuations are nowhere near what they were at those insane levels in 2000. I thought this was really interesting. I don't know if this is good or bad. I put it in kind of the negative section, but what's really interesting is largely because of the demographics in this country with a lot of baby boomers. If you go back to the low of the financial crisis and you add up all the money that's gone into stocks and all the money that's gone into bonds, and everybody's talking this year about how much money has gone into stocks this year. It's true, but look at this. Cumulative since the financial crisis, look at how much has gone into bonds compared to what's gone into stocks. In a lot of ways, you could make a case that stocks need to take a lot more capital flows in to right size where they are in the economy. And a lot of people are still very, very nervous about the stock market. So arguably, there's still room to run there. This is something that's getting a lot of media attention. We won't spend a lot of time on it, but it's a real problem. It's a problem for corporations. It's a problem. It's actually, my point in this is that earnings actually could be better than they are. There's a lot of companies reporting, let me jump to it, a record number of companies reporting that they could be selling more if they could get materials or get employees, that they literally can't fulfill the demand. Look at that chart. We've never seen anything like this, okay? And we're seeing it across the board, right? We're seeing it in semiconductors, right? Went from 5-week delivery times to 22-week delivery times. How about getting a container out of Shanghai? You want to ship something from Shanghai to LA, 6 times more expensive than 18 months ago, right? Really hard to get your hands on a container. Why? They're all sitting at sea. There's 7% of every container in the world is actually parked on an ocean somewhere just waiting to get into a port. There was no wait time coming out of COVID, none. And now look, the economy is so hot and nobody was prepared for this. We got caught flat-footed, can't hire truckers, can't hire dock workers, can't get enough inventory out of China, and this is what you get. You get real backlogs, right? And inventory is way down. I'm only putting this slide in here as a public service. Get your Christmas shopping done by November 1st, or you're going to be screwed. You won't have anything. There are no inventories anywhere. And this is, again, this is not indicative of an economy that's having problems. This is exactly the opposite. A risk of maybe running a little too hot. We finally reached it. We've been talking about it. It's the same price to buy a brand new car as it is a 1-year-old car in this country. Totally the bizarro world. Again, can't get parts, can't get supplies to get a truck fully off the assembly line. And I'm kind of going to close with this. This is the thing that always worries me the most. You've heard me talk about it a lot over the last several quarters. Okay, this makes no sense whatsoever. We're going to examine the weakest 20% of the publicly traded companies in this country, okay? Weakest in terms of balance sheet, okay? Interest coverage ratio. In other words, my debt service expense is this much, and my profits are this much, and let's compare them. These are the companies. If you're under the gray line, you have to borrow every quarter just to stay alive because you're not making enough in profit. Okay, that's these companies. We know the dot-com was like this because all the companies were coming public. They didn't even have revenue, much less profit, okay? But let's look at a normal recession. In a normal recession, that's the great financial crisis. How on earth are we in such worse shape than we were during the great financial crisis, right? The weakest 20% of companies that are publicly traded are much weaker than in the financial crisis, okay? This is something not getting a lot of attention, okay? It is ultra low interest rates and really easy money. So we have a lot of companies that are able to borrow that should not be borrowing. They should be bankrupt. But you've got people desperate to get return on cash. And the reason we bring this up, and we bring it up all the time, is you absolutely want to be disciplined about what you own. The worst investments are almost always made in the hottest markets. And this is one of those times where we're starting to see really crappy investments in the system. Business plans that go around, funds that get launched that are pure garbage. So we really are encouraging clients to stay disciplined about your financial plan, working with your advisors on understanding really truly what we own. And there are a lot of, quote, safe bond funds out there that are not. they are bloated with this kind of paper. There are some funds in the system that look like they're investment grade that are as much as 1/3 junk bonds sitting in those bond funds. So really, really be aware of what you own, because in the next real recession, not necessarily a COVID event, but a real recession in this country, and it might be a year or 5 years, there are going to be a lot of bankruptcies. There are a lot of companies walking around that should be already gone. All right.
Great.
That was a lot.
Yeah.
That was a lot. Okay. All right. I'm going to hand this over to Josh. Josh is going to dive into some inflation issues, which is obviously a hot topic as well.
Yeah. And I think this fits well with the concern side of things. But yeah, so quick inflation update. So we've been talking about inflation really since Q1 of this year. And there was a lot of noise in Q1. Then it seemed to kind of die down as the year went on. And now it's going to come back up again. The reality is, and our view has not changed much, I should say. I think we still are in that transitory camp. But I think that what we've realized is because of all the supply chain issues that we're seeing, these supply chain issues are taking much longer to fix than we had expected and kind of forecasted in Q1. And so the reality is that inflation is going to be a little bit stickier than what we originally were thinking a few quarters ago. And so inflation definitely real. It's going to be stickier this economic cycle. I think through the whole cycle, though, it's going to normalize, and it's going to be normalized in that kind of 2 to 3% area. The reality is that there are some major drivers to inflation, and we're seeing that, right? Wage inflation, Kurt talked about this and showed a few slides. Housing, that is going to be a driver, a secular driver of inflation through this cycle, I think. And also just kind of a shift from globalization, a shift from importing goods and producing goods in the United States is going to be a driver of inflation on the margin. The primary drivers of inflation, I think, are still transitory in nature, but there's going to be this step up, right? So I almost think people need to stop talking about transitory and start talking about a step up in the cost of living that we're going to see. Because the reality is you go to restaurants, it costs more money to go to restaurants right now, and that is not going to change. It is that step up. Even if things get cheaper for the restaurants to buy, they are not going to reduce their prices, all things being equal.
Because some of these inputs are really sticky, right?
Exactly.
Like wages don't go down very easy. Certain things don't go down.
The food may get cheaper to buy,
right.
But the reality is these restaurants, unless all these other restaurants start cutting their costs, they're not going to be incentivized to cut their costs. So,
right.
So there's this kind of weird step up in the cost of living that we're experiencing right now, and that's going to stay there. And I think we all just have to recognize that. But I don't think that we're going to see things continue to snowball where inflation continues to feed more inflation and we get into this kind of almost hyperinflation.
What do you think the real inflation run rate, like when I say real, I shouldn't use that term, but the actual inflation, like the Fed wants us to think it's 2.5.
Yeah.
The fear mongers want us to think it's 6.5 and it's hyperinflation. Where do you think we really actually are? Like a year out?
I mean, I think it's going to be higher next year. It's obviously high this year in like that 4% area. Next year, it's probably going to, be kind of in that low 4 into 3%. And then hopefully, as long as the supply chain issues get solved, we'll be back on that path where within a couple of years, we'll be back in that like 2%.
You think so? You think we'll get back under 3 again?
I
sort of get
so.
some of this normalized.
Yeah. It may take a little bit of time. It's taken more time than I expected originally, but I think we're getting there. And the reality is, like, the federal government, they're recognizing this. Like President Biden is talking about this and talking about, hey, we need to fix the issues about like all these cargo ships that are sitting there. We're going to send more workers over there. So the government is now getting involved, which for better or for worse, who knows?
He's tired of all the memes blaming him for all the inflation, right?
Exactly. So they know it, and they're going to start putting assets towards that. So long term, though, I think the secular disinflationary forces are still there, right? Technology, and we're seeing this. Things are going to get cheaper because of the adoption of more and more technology and more advances in technology. And we're seeing that, for example, like, you go to some of these restaurants and you can now just go and you can click a few buttons and you can order your food. So now they no longer have to pay somebody to stand there and take your order. Right. Those are technological changes that will make things cheaper. Aging demographics, definitely a driver of disinflation. Although there's the shift from globalization that we're experiencing, I think that the pendulum will swing back, and you'll go back to that kind of long-term trend that we've seen over the last 20, 30 years with globalization. So let's look at some of the data that we've seen most recently. headline inflation, so this includes energy and food, has obviously spiked up, but now has kind of flattened, which is what we would expect. Core inflation has actually come back down a little bit as some of the drivers in core inflation have softened lately. The two biggest drivers of inflation have really been used car prices, and we've talked about this. This is really for core inflation has been the biggest driver, right? Used car prices skyrocketed, but they came back down, but they're coming back up again. And that's just because of the supply chain issues that we're seeing. And then the same thing for in just general overall inflation, headline inflation, it's really energy. And so you've seen we had, energy really sold off during COVID. It's come back up. Our energy, the price of energy right now for oil for a barrel of crude has bounced back to well, above pre-COVID levels. And so this is going to continue to be a driver of inflation for at least a couple more quarters. And then from there, I think this will kind of flatten out. Here's something that people, I saw recently that I thought was interesting, because there's supply chain issues, but then there's also some other one-off factors. Here's an example of supply chain issues. The UK and just Europe in general, Asia, they are a net importer of natural gas. And there's all these issues around the production of natural gas and oil in general. And you're seeing that, causing a massive spike in the natural gas prices. That then is going to feed into a bunch of other things that are going to be inflationary, such as just the natural gas that you pay for your house to heat your house in the wintertime. It's feeding into things like, I was listening to a podcast that they were talking about a steel manufacturing plant that just shut down because natural gas prices were too high for them to operate. So they're just like, we're not even going to operate because natural gas prices are too high. So that is then going to feed into some more supply chain issues in the future, where then now you're not going to have as much steel as you were expecting or previously. And so there's still some hiccups that we're still going to have to work through. And so we still have, at least a few more quarters of issues related to supply chain.
I always feel like in commodities like this, whether it's iron, nat gas, crude, whatever, I always feel like I never worry too much about it, and maybe I should, but it's sort of like in that business, what secures high prices are the high prices, right? Because then what happens is people, remember when nat gas, they were giving it away, it was like so cheap.
Oh, yeah.
So a lot of people shut down their production of nat gas. So when the prices go back up, it's like all of a sudden new production comes online. People are going to find a way to get it back out of the ground and get it back to market again.
Yes.
And so these things seem more temporary to me,
Yeah, at these prices, you're going to have countries start exporting natural gas to Europe and Asia.
It's a profit center now, right?
Exactly. Yeah. So this will solve itself, but it's just causing these short-term kind of supply chain issues. This is interesting because, for example, they're just around related to what crops were attractive to plant. Oats weren't as attractive as maybe corn, for example, during this year. And so less oat was planted. And on top of that, there was a lot more droughts this year than in previous years. So you're starting to see oat prices rise a ton. So you're seeing weird kind of one-off situations that are going to drive inflation as well. I just want to bring that up because that's kind of an example. Let's dive into the numbers. This is the most recent numbers that we saw for last month for inflation. The reality is, and I already talked about this, energy is the major driver of the inflation, headline inflation right now. If you look here, the weighting of energy, 7.3%, but it makes up 33% of the overall inflation number. So obviously, like, energy is the 800-pound gorilla in the room, but we're starting to see a little broadening of inflationary pressures. And so we're starting to see, for example, food at home came in at about 4.5%. That's almost twice as much as it was a few months ago. Energy services came in at about 8.5%. And energy services, for those who don't know, that's utilities. So you're talking about natural gas coming to your house, electricity, all those things. So that's come up a little bit. So we're seeing a little bit of a broadening of the inflation, what's driving inflation. But the reality is it's still really energy. And that you give this another year, and that year-over-year number is not going to be quite as strong. Looking at core inflation, it's what we've talked about before. You have new vehicles and used vehicles that have a weighting of close to 10%, yet make up over 35% of the overall inflation number. So once the supply chain issues, we get through this, that's going to come down. Used cars are going to get cheaper. And so that's not going to be as big of a driver of inflation.
And it's
But
interesting
there-
how it moves around. You actually see it in these tables because we watch these tables every quarter.
Yeah.
It's
Yeah.
interesting how it's been migrating around.
Yeah.
Because what it'll do is spill over. This gets normalized, but now we've spilled over a new problem.
Yes.
Here. You know?
Exactly. And so now we're starting to see a little bit of broadening of core inflation. So that's excluding food and energy. And we're starting to see that a little bit more, for example, in shelter. We're starting to see that in medical care commodities, alcoholic beverages. There's a few things that are starting to cause a little bit higher inflation as far as core inflation goes, but nothing that's really concerning at this point, and nothing of the same magnitude as what we've seen with energy and then the used cars and trucks and even new vehicles to a certain degree. Okay, we'll pass over to
Awesome.
Monica.
Thanks, Josh. For those of you who don't know, that's Josh Flade, and him and Monica Saunier are here with me and head up our fixed income group, which kind of oversees everything for our team, from credit to interest rates to underwriting and credit quality and things like that. So go ahead, take it away, Monica.
Okay, thanks. Well, I'll give you just a quick overview of what's going on at the Fed and how the markets are reacting to that. And of course, all the things that Josh was talking about with inflation is one of the big focus points that we feel like the Fed is watching. And you probably all are sick of hearing the word transitory. That's been talked about quite a bit in regards to the Fed. They're sticking to their story right now in terms of the inflation being transitory. And what that means, of course, is up for debate. But I think at this point we can assume that they're not saying that inflation isn't sticky, and that the absolute level of prices that we're seeing right now, especially in regards to wages, is probably not going to go down. Some things don't go away like that, but just that the rate of growth is not going to continue to accelerate. Things can't go to the moon. It's not going to continue to just accelerate and accelerate it. But that's their story, and they're sticking to it, and it's pretty important because that's part of what I call the three-legged stool. They're still focused on the three things, including inflation or stable prices, meaning in a sustained level of inflation that's not above 2%. They want maximum employment, which means an unemployment rate somewhere below 5% or somewhere around where we had it, pre-pandemic, which I think was at 3.8, 0.9, something like that. So, but also a return to full employment, and that's I think going to be the sticky point right now. Right now they are signaling that they're going to perhaps begin tapering, and they may announce that at the November meeting. Although with the latest unemployment numbers that we saw, that seems to be a little bit in jeopardy. There was a huge miss on the employment numbers. The last report, the market was looking for something like 500,000 new jobs and only got 194. And that's really unheard of. And that's another point I wanted to bring up in regards to the Fed, is that just the trying to get a gauge on what's going on in the economy, particularly in employment post-pandemic, is just really, really difficult, because who knows what some of these numbers mean in a world where everything is disrupted, supply chains and the labor force, and just how people are working and where they're working. Everything is just changing, so that the old ways that we had of getting a handle on what those numbers are is just, who knows if we're right or not. And obviously the market missed it big time on the last employment numbers. But the dot plots, which is basically just sort of a graph that shows you what the different Fed governors are thinking in terms of when they think the Fed is going to be able to begin tightening. They're saying 2023. The market thinks that it's 2022 and late 2022. So, and I'll just say, historically, the Fed's been not very right about that. And the market tends to get a little bit righter. But, I think that they may have to wait, put off the beginning of the tapering until after November, again, because of the bad showing on unemployment. But, even if they were to begin in November, tapering is not tightening, and tapering will take about at least a year. So even if they were to start, say, tapering in December, it'd be late 2022 before they finish.
And we should clarify that. I think it's a really good point. When we talk about tapering, we're talking about slowing down the rate that the Fed's injecting liquidity.
Correct.
Not removing liquidity.
Correct.
These are two different issues, right?
Correct.
That's the difference between tapering and tightening.
Correct. They'll just start trimming the balance sheet a bit, selling some securities, not buying as many securities, and that generally, because it's removing some liquidity from the system, it is going to result in slightly higher rates. At least we think so, but At this point, with the demand that there is out there for bonds, I actually don't think it's going to have as big an effect as anybody thinks. But that's really the bigger concern for tapering, is just the effect on the supply of bonds, prices of bonds. And again, tightening just could begin much later down the road. But also this particular Fed, they're telegraphing all of their moves very well in advance. And they're not big, bold move makers. If you're old enough to remember the Volcker Fed, as some of you might, that was a Fed that made huge, big, sudden, bold moves. They had to. They were fighting rampant inflation, and that's what it took. This Powell Fed is not like that. They're more like getting a squirrel to come to them. They're not going to make any big sudden moves.
And a lot of telegraphing, right?
A lot of
like, we're going to tell you what we're doing.
Right. So I wouldn't expect huge moves either from the Fed or huge moves in rates because of that. But a couple of the bigger problems for the Fed right now is, this issue that, Kurt, you alluded to a little bit of, where have all the workers gone, and the problems that this presents for the Fed in trying to get a hold of what the numbers are. There are millions and millions of workers who just never returned to the workforce. And when these people were initially missing, people assumed, oh well, they're either on unemployment and they want to sit on their couch for a little longer. Maybe their kids haven't been able to go back to school. They don't have childcare. Maybe they're just not comfortable getting back in the workforce because of the virus. There's also this big theory of YOLO, you only live once, that a lot of people are just saying, to heck with work. I want to go travel the world, or I want to go, we can't travel too much, but I want to go experience and do things in life. And so they're just not coming back to climb the corporate ladder. But also,
and there also seems to be a misalignment in training. A lot of the open jobs are in things like tech, programming, engineering, and a lot of the people unemployed, they don't have that kind of training.
A lot of the jobs are also in things like truck drivers.
Right.
Maybe people just don't want to do that.
Who wants to drive a truck, right?
It's not what people want to do, right?
Yep.
Or what they're trained to do. But there's also been a huge surge in new businesses started. Lots of people have just decided they don't want to do the grind at, an office or work for somebody else. And so they're starting new businesses. And also a lot of people theorize that, they're just not being paid enough. Again, whether it's unemployment or not, that's competing for that, that they want more pay. So, but, as more and more businesses are increasing pay and the unemployment is falling off and kids are going back to school, people still aren't coming back to work. And so people are going, where are these people? Where have they gone? And are they ever going to come back? So it's a big question right now. And I suspect, as in most things, it's a lot of these factors. It's not just any one factor. We know anecdotally that a lot of people have retired early from many professions, specifically teaching. Teaching has lost a tremendous amount of people to early retirements because of the pandemic.
Nursing, look at what's happening in nursing.
As well,
and,
right.
Yeah.
So that's going to be a big thing going forward with the Fed, try to get a handle on the workforce, the numbers, what it all means, and are we ever going to get back to the level of labor force participation that we had pre-pandemic, and what this all means for their policy as well. Because I think at the end of the day, we talked about the three legs of the stool. Are looking for GDP growth, they're looking for a return to maximum employment and a low sustained level of inflation. And I think in the priority of things, they know they've got GDP. That's not a problem, right? And inflation, they're hoping isn't a problem, but unemployment's the one they're really worried about. And so I think they're going to play to that.
And they've made it really clear that they're playing to that, right? They've said, we're not changing this until we get this employment picture right.
Yeah. I think that they realize that if that's the thing, that if they get wrong and they tighten, they kill the economy or cost the economy a lot of jobs, that's what cost them their jobs. And I think at the end of the day, that's going to be the more important.
So let me ask you, so in the years you and I have known each other, to your credit, you've been almost spot on about the Fed. So I'm going to put you on the spot. The burning question I have, and so many other people have, is when you inject this kind of liquidity, Fed's still buying a truckload of mortgage bonds, even in this market, right? You're running the risk of running too hot, right? And creating a little bit of too much financial hazard. We're not seeing it yet. People are not out over their ski tips. We're not seeing insane risk. But the risk is that we run too hot, and then you start having the problems that come with that. Is it fair to say that the Fed is going to err on the side of too easy and too hot, then pulling back liquidity too early. Is it fair to say that?
I think so. I think so. Because, as I mentioned, I think they see that as being the bigger risk to stifle the economy. But I think they also realize that some of the things, particularly quantitative easing that they're doing, that doesn't really have a huge effect of making the economy run too hot. The average consumer doesn't go out there and spend a ton of money because the Fed's buying more bonds.
And they're obviously not borrowing more money with low rates. Nobody seems to care that rates are low. It's not encouraging people to go borrow more.
Right. We don't have the kind of environment we had before the great financial crisis, where people were borrowing to do everything. They were running up huge credit card balances, and they were buying houses they couldn't afford, and they were leveraged up to their eyeballs. And we don't have that now. So I think that the Fed realizes that, and they see that the danger of enabling an overheated economy is very low compared to the danger of stifling them.
Is there anything else that scares you then? I know for some of us, we have this small fear in the back of our heads of what's the long run risk here of creating money, of expanding M2 in the monetary base. And we kind of know what the fear mongers say, but are you worried about that? Are you worried that we're creating too easy of monetary policy? I mean, MMT has been something we've debated for a long time.
Yeah.
I personally am not scared of that, but a lot of people, this really makes them nervous.
I'm not so much worried about the implications as far as overheating the economy per se, but I think the implications for very long-term low rates are a little bit scary. And that's, looking at the experience of Japan, what it could mean to their economy. And I think we're kind of right behind them in that we have so many people that are getting close to retirement, will be in retirement mode, that low rates really crimps their style.
Yeah. How do you retire when you make, right.
So I think just those longer demographic changes that I think in some regards have been a bit accelerated because of COVID, because I think one of those where of all the people gone factors is that a lot of people have retired. Early. And so some of these things that would have been an issue anyway in 10 years, maybe 15, are coming to roost right now. And so that actually scares me a little bit more, just those longer term, especially if you figure that the other workers that would have been there to support Social Security and all the other systems maybe aren't there yet.
And so do you think it's fair to say, it seems like because of what we're talking about, you have to be comfortable with risk assets being a little bit more expensive because of the environment. Do you agree with that? Or
yeah, I think so.
It's like the capital has to go somewhere.
It does. And those things are cyclical.
Yeah.
But I think this cycle is going to be a long one.
Yeah, I do too. Okay. Are we throwing back to Josh, or are we?
Sure. Just real quick on kind of, look at rates and just kind of, we've updated this from the last time we looked at it. Kind of similar situation. We're just a little bit steeper on the yield curve than we were, a quarter ago or a year ago. But, still, if you think about this from historical context, we're only, the 2 to 10 year spread is only about half of what it would normally is over, say, the last 20 years. So although it looks kind of steep, just because it's what we're used to right now, it's not really that steep. And we're still way ahead of the rest of the world in interest rates. We still have a lot of the world that's in negative interest rate territory. And this one other thing that's kind of putting a little pressure on the Fed is that most of the other developed markets, economies, their central banks are talking about tightening a lot sooner than the Fed. But at the end of the day, again, I don't think they see the rest of the world as being their pressure point, in terms of what they're going to do. Again, I think they're really going to stay very focused on employment. So, I'll turn it back over to Josh.
Thanks, Monica.
Yeah, I'll be fairly quick. The reality is we've kind of been in this interesting environment for 2021, and actually our fixed income team recently kind of did a study looking back over the last probably 25 years at volatility in spreads, and this has been one of the most or I should say least volatile years in the last 25 years. And you can kind of see that where, spreads obviously on investment grade bonds, relatively tight compared to historical levels. And there has not been a lot of volatility this year. And we expect that kind of through the rest of this year. Same thing for high yield bonds. Spreads over treasuries, relatively small and not a lot of volatility. And so it's ended up being a pretty good year to be long and credit basically, right? And whether it's investment grade or high yield, it's been better for high yield just given rising rates. But overall, we're kind of in this environment right now, lower volatility, and spreads are relatively tight. Looking at municipal bonds, broadly speaking, I think we think that municipal bonds are definitely attractive relative to investment grade corporate bonds for a client in the highest tax bracket. And so that continues to be the case. It was the case last quarter, continues to be the case right now. Investment grade corporate bonds and high yield corporate bonds are both experiencing the same situation. Like I said, spreads are tight and they remain near kind of all-time lows. Volatility is low. And the corporate balance sheets on a lot of these companies, I'd say the vast majority, remain strong, and that these companies are actively managing their liabilities. They're paying down debt early. They're looking at debt that they have that maybe has a high coupon payment on it, and they're going ahead and they're retiring that debt and they're issuing debt at a lower coupon rate. So companies, whether they're investment grade or high yield, have been very proactive in managing their liabilities, which is good for them. Even companies that are still suffering from COVID, right? This week we saw Carnival, they came in and they issued some debt this last week in order to pay back some higher coupon debt that they had issued last year. So companies are being proactive. Even companies that you would think are still definitely suffering from COVID, they still have access to the credit markets. And I'll turn it back to Monica. She's going to talk a little bit about taxes.
Hey, I get the great honor here.
And by the way, can you tell us what's going to happen? There's a lot of people waiting.
Something's going to happen. I mean, it's going to be fairly big, but it's not going to be as big as President Biden wanted. That's
Okay,
about all
good.
we can say at this point. I know there's a lot of chatter today in the news, and we've been hearing people saying that they're this close to a bill or an agreement, and I would not be fooled at this point, though. I think they will probably have a framework, if you will, on a bill for the budget, possibly this weekend, but a framework isn't a bill. So I think there's some factions within the negotiating that really want to make an announcement this weekend. And I think what they're going to announce is just that they have a framework, but there's still a lot of things to be hammered out. So since we last talked about this, the Senate did pass an infrastructure bill, a much smaller one than what they had originally hoped for, but it does include a lot of big projects, roads, bridges, tunnels, water infrastructure, some of the kind of less infrastructure like things that they may have talked about initially kind of got taken out, but it is a big bill. It's 1.2 trillion, and they still have to figure out how to pay for it. So the bigger focus right now, because it sits in the House, and within the House there are a lot of different factions within the Democratic Party that are refusing to vote on either bill until they get agreement on all of the spending that they want and all of the tax provisions that they want, and they all want something different. So it's quite a big project for President Biden to get what he wants in terms of clean energy spending and a lot of big social projects like paid leave and healthcare coverage expansion and more child tax credits, all of these things. He needs every single Democratic vote because he's not going to get any Republican votes. And there's just, again, several factions within the Democratic Party that want very different things, either for their constituency or for even themselves personally, that are causing them to say, we just won't vote for this, or we won't vote for it if it doesn't have this. The SALT deduction is one of the bigger sticking points. Obviously the high tax states like New York and New Jersey and California, they're saying they won't support any bill unless they get a repeal of the SALT deduction limitation that was set at $10,000 in the 2017 tax bill. So we're hearing all sorts of things right now. There probably will be something in the bill that will change that, whether it will be sort of a temporary repeal, maybe a 2-year repeal, or maybe an increase to 24,000 limit. That's also been put on the table. There probably will be something to appease those particular lawmakers because nothing will get passed without them. It looks pretty sure that the corporate tax rate will be increased. Not sure exactly what it will be right now. There seems to be some agreement around 26.5%, some minimum tax on overseas profits. The personal tax proposals Some of them look pretty likely to pass, like getting the top rate back to 39.6%. And the level that would kick in, we're hearing, is somewhere around 400,000 for single payers, 450,000 for couples. Also increasing the capital gains rate. If you recall, Biden really wanted to get that up to the same as the top wage rate, or 39.6. Doesn't look like he'll get there, but he may get it to 25%. That would be obviously just for the people in the highest tax bracket. So, not a welcome change, but not as big of a change as we might have feared. The step-up basis elimination also was a big thing that people were talking about and kind of worrying about whether they might eliminate that altogether. It doesn't look like they're going to limit it altogether. And I'd even be a little inclined to say that may get thrown out altogether. That's the one thing I would almost think. There's just so much disagreement around at what level to put it. Right now, they're talking about only eliminated on gains over $1 million and giving some exemptions for things like family farms and family businesses, but that's a big area for disagreement. So yeah, I wouldn't be surprised if that ended up getting thrown out. They're talking about limiting the pass-through deduction to 400,000 for singles, 500,000 for couples. Also extending the carried interest deduction holding period out to 5 years. Those are things there doesn't seem to be a lot of disagreement over, so I would expect to see those. The estate tax, they're talking about repealing the increase that they passed back in 2017, setting it back to the old levels. I really don't know right now where that's how much support there is for that, although I would kind of expect that might be another one of those things that gets thrown out at the end of the day, because they are, as we speak, sort of chopping the bill back. They were originally talking about $3 trillion total. It's now maybe 2 to 2.5, and it just keeps shrinking. So I think some of those bigger things might end up on the cutting room floor. One thing though, that's very, very likely, I think, to pass, they are going to be increasing the IRS budget to hire lots and lots of new auditors to try to close the compliance gap, they call it, and that's the gap between what they think people owe and what people are actually reporting and paying taxes on. And aside from new auditors, one of the ways that they want to do this is also start getting your bank to tell them how much money you're having deposited in your checking account. And their theory is, though, there's lots of higher income people out there that have income that they're just not reporting because it's not coming through traditional channels that would get a 1099 report. Right now, what we're hearing is that there is support for something like a $10,000 limit, meaning that any deposits to your account over 10,000 would get reported to the IRS. And so presumably if there's some question or pattern in someone's account as to whether this might be unreported income, that you can expect a knock on the door and they'll come asking you about it. So that looks it looks actually fairly likely. So so again, nothing's really off the table, I'd say, at this point, but some things look a little bit more likely than others to pass. While it will be a lot of money, it's not going to be as much as the president wanted initially. And what will all this massive spending and tax increases, what effect is that going to have on rates and bonds? And, we've talked about this before, where, the classical theory of economics says that when you have tax cuts, you get lower interest rates, you get higher employment, you get higher economic growth. And so you'd expect if you have tax increases that you'd get the opposite. And while we think that's probably going to play out, the effects may be a bit muted at this point because of the effect of the infrastructure spending. There's going to be lots and lots of projects out there that are going to spur employment and growth in and of themselves. And so just depending on the size and scope of all the spending that gets passed, we would expect that it would nudge interest rates up over time, and probably inflation as well. And so, I think, we're probably looking at an inflation level that's maybe closer to 3 than the 2 we might have otherwise been looking at. As far as bonds, obviously, anytime you increase personal tax rates, it's going to spur the demand for municipal bonds. It just makes them more attractive for more people. But demand, quite frankly, for munis right now is so strong and so insatiable that I don't know if anybody's going to really notice the difference on the overall market. Plus, again, with the infrastructure spending, that's going to increase the supply of supply of bonds, because a lot of municipals are going to have to increase munis their issuance to fund a lot of those projects. So all in all, though, the benefits probably skew more to the higher tax bracket. As far as the stock market, if you recall back in 2017, when they passed the big tax cut, we got this huge, increase in stock multiples. And I think we give some of that back if we get the increase in the tax rates. Some people argue that's already in there, that's baked in the cake because everybody expects it. But I think there's probably going to be some effect once we know the actual.
Especially if there's some really
details.
huge surprises that are to the negative.
Yeah. Now, one thing though, I think that's really interesting that I've been watching for, there hasn't been any mention at all of increasing the rate on qualified dividends, which is a big plus for some of the stocks. The rate that you get on qualified dividends is very favorable, and they haven't talked about increasing that at all. So I think that's probably going to mean a big plus for high dividend stock strategies.
Yeah. And with corporations holding so much cash, it might be an interesting way for them to incentivize shareholders. It's a little bit more tax friendly as well. So
yeah, absolutely. So again, a lot of chatter about getting some kind of an agreement this weekend, but I wouldn't be fooled. I would think they're going to get a framework, which is not really a bill, and that they're going to continue to wrangle. And I'd be really shocked if there was anything definitive before December.
yeah. Okay. Awesome. Monica, Josh, thanks you guys so much. Appreciate it. Okay. Well, and let me just end with this. This is our game plan going forward. The things that we're emphasizing most with clients. Number one is this idea of avoiding complacency. As I mentioned earlier, when times are good, this is when people make reckless investments. This is not the time to be getting out over your ski tips and investing in things that just are not fundamentally sound. Again, it's that discipline of really understanding what you own, both in your normal retirement plan, but also the thing that your cousin brings to you that he wants you to invest in Mexico. This is that, almost all of the bad investments are made when times are just really good. And it requires being disciplined and not making bad investments, right? Owning really high quality assets, rebalancing your portfolio. If you go back a couple of years, and you had a 60-40 blend between stocks and bonds, and you haven't rebalanced it, that is skewed. And you want to have the discipline to be able to take some winners and reduce them, and then invest in things maybe that have not performed as well. We did that a couple times last year. It allowed you to buy some energy, buy some bank stocks and things like that. So that's really important. Probably going to have some more volatility going forward. We've had remarkably calm markets. We finally just had a 5% correction in the S&P 500 after 18 months since COVID. We're probably going to have more than that. You get an average of a 14% drop every year. We just haven't really seen that. So it's easy to become complacent and think that risk assets just go up all the time. And people have wanted to abandon having bonds. There's been a real frustration with owning things that aren't making you a lot of money. But there always is a place in our portfolios to have some really liquid, really safe assets. So that, and even though you're not being paid a lot on them now, when markets get rocky, it gives you the flexibility to do something. If you need the cash, you have it there. If you want to buy some things that have gone on sale, you have it there. So it gets tempting to get more and more aggressive as markets get better. But there has to be a part of our portfolio that is disciplined and liquid and safe. We also, unfortunately, and this is the part of the barbell, are going to have to be used to, at least for the time being, assets being a little bit more expensive than normal because interest rates are so low and there's so much cash in the system. So, Josh, anything else to add before we jump off?
Good.
Monica, anything else? Okay. Really, really appreciate everybody joining us this quarter. Hopefully this is helpful. Again, we'll send out everybody that's on this call. We'll get an email tomorrow. It'll have the slides. It'll have the replay link, etc. Feel free to forward it to friends and family, whoever. And we'll see you again next quarter. Have a great fall. And we'll talk to you soon. Take care.